the the objective of today's session, and I'll be looking for input on the content that we've presented. I originally did this presentation to a team of budding young entrepreneurs during COVID for Innovate Durban, who I serve for. And the objective, not to try and give everybody yeah, a full 7-year varsity career and 30 years experience in 35, 40 minutes, but to just try and use some of the experience I've had to try and demystify numbers. And at the end of today, what I'm really hoping is that you've gained a little bit more knowledge, perhaps feeling a little bit more equipped, a bit more confident, and a little bit more insight into where to focus.
Jochen, oh, sorry, you've muted. I muted you by mistake because I wanted to tell you that your slides are not showing. Sorry, I made a mistake. Can other people see the slides? Because I've lost them.
Okay, I probably shared.
Sorry, in trying to unmute myself, I muted you by accident.
No, that's fine. Apologies for that.
Thank you.
All right, is that?
We can see your notes. Now your slides have disappeared.
All right, they're coming back.
I would just like to say at this point that this was sorted out at 5 to 1. And then the slides disappeared. I mean, isn't that so typical? Now we can see your whole PowerPoint.
Okay, should. All right, how's that looking?
There we go. Now we can see your slides. Thank you.
All right, can you see my notes now?
No.
Great. All right. I think I got kicked off earlier on.
Thank you.
Okay, ladies and gents, sorry about that. I'm just trying to get my pointer reactivated because we probably will need that shortly. All right, there we go. Can everybody see the pointer? All right, so just to recap again, the objectives is not to make you all feel like experts and fully ready to challenge deep financial analysis, but really to just start a journey of becoming more comfortable. I'll also say to many of the people I do this presentation to, and I've done a combination of virtual and on-site, and I must say I enjoy the on-site. It's far more able to engage with the audience a lot better and ask questions and animate some of the answers. But the constant message that I try and give is, if an accountant cannot explain a number, change the accountant. There shouldn't be any number on a set of financials that your bookkeeper accountant can't explain via a detailed schedule or some evidence of a transaction. So ask the question. All right, so the plan for today is I'm going to take you through some very simple little diagrams, which I found quite useful. So in my time at NUMSA, working as an accountant on their legal rapid response team for retrenchments, we often had limited information and limited time to do an assessment of what was there. And people were always quite amazed at how quickly we could come up with a diagnostic. All right, but I'm going to bring in the simple maths. For me, financials are about profitability, liquidity, and solvency, i.e., how much money are you, what profit are you showing, what's your cash flow like, and are you solvent? Now, if you just apply a flag, a red flag, a green flag, or an orange flag to any one of these items, so is your profitability red, i.e. bad? Is it green good, or is it orange? You sort of break even. How's your cash flow? Red, yeah, not making my creditor payments. Green, I'm in a position to pay dividends, take big salaries, etc. Insolvent, trading recklessly, etc. But if we just apply that red, green, orange across these things, there's only 9 permutations of the financial position of a business and an organization. And depending on that combination, those 9 permutations dictates very heavily which direction you can take. Now, it's obviously not static. It's like an engine, and that's why I use the cogs, because profitability can turn, liquidity can turn, so can solvency with factors that happen potentially outside of your control, but sometimes in your control. So I'm going to spend a bit of time delving into how we get to this, how we understand it, how important it is, but just generally from your own finance perspective, your business, personal, but also your clients. And for me, this aligns with like any mediation. Any mediation, you're trying to understand where you're trying to get to. Well, exactly the same in finance business is setting your goals. Then it's about recording and actually making sure that all your transactions are actually accounted for and presented in such a way that you can do something with it. So you can see these 9 permutations and what to do. And then I'm going to spend some time just taking you through a little bit more insight as an entrepreneur, but potentially as a professional doing mediation. If you presented with a set of financials, essentially some of the things to look for. And then my best is, when it goes wrong. And, it's not if it goes wrong, it's when it goes wrong. Okay. I once had an interesting conversation with a bookie, and I mean, these aren't typically people I certainly didn't go down a career path of an accountant to become a bookie, but very interesting. A bookie on a horse racing event gave me an example of how many things could go wrong in a horse race, which would mean that the odds were always stacked in his favor. And I've seen exactly the same thing in business. And that's why there's a strong gist towards risk management and governance, because so much can go wrong. And then how to do better. So high level, that's what I'm setting out to achieve in this session today. And again, temper expectations. It's a high level, hopefully just helicopter view. So one of the most insightful things I was told by one of my mentors is, you're in business to make money, make a difference, and have fun. And it's a very simple equation. If you're not making money or a difference, you better be having fun. And if you're having too much fun, not making enough money or difference, you better start working hard. So I've always come back to this and try and get a bit of balance. And funny, accounting is all about balance. And they always say old accountants never die. They just go out of balance. So starting with the goal, what goal do you want? And I start this with some of my young entrepreneurs. And in the innovation space, we're dealing with township kids, but I deal with some of my entrepreneurs, and I'm talking about 100 million businesses going to R1 billion businesses, and the separation of role between shareholder, director, manager is often misunderstood and confused. Particularly, I see this in the dispute resolution space. Currently involved in a business that has not performed well, and now we're trying to resurrect a relationship, which we know is not going to ever resurrect. So we're now into a termination of employment, a removal of director, and a return of capital, i.e., getting back the share certificate. So yeah, quite tricky. But what do you want out of this business? Yeah. Is it a salary? Is it a bonus? Is it a dividend? Is it a capital on sale at some day? Was it all of the above? And as you transgress or as you evolve in your business, step one is just pay the water, electricity, and bread and milk. It's typically a salary or withdrawing, a bonus. If you're in a business, then you'd like to see some return on your capital. So a dividend payment, which pays for lifestyle and helps you to divest and diversify. And then capital on sale. And that's where a lot of our wealthy people have actually made their money, as they've built up a business, paid themselves a salary along the way, lived within their means, lived off dividends to build up diversity, and then are able to sell a business many years later and reap the benefits of the reward. And we keep saying to people, with your money, make sure you diversify. But we continually go and put all our efforts into ourselves and in our businesses and put all our eggs in one basket. So at some stage, you've got to be thinking of succession, exiting, and diversifying your own source of income. but an aspect of legacy and an aspect of fun. Personally, I choose to live in Durban. I've landed up working effectively by myself, which gives me opportunity to spend time with kids, do my running, and I've been very fortunate that I've picked up a nice little portfolio of NGOs, which I get paid for doing CFO work for, but also sit on the boards of one or two. Very rewarding. All right, this is a slide I've unfortunately had to use in many presentations within the NUMSA environment and CCMA training, where in a labor environment, businesses have to generate a return greater than you would get in a savings account. And that just comes from the point of view that your savings account, you're going to get 5 to 6%, and it depends on which cycle of the economy you're in, but it's risk-free to a large extent. We haven't had a bank really go broke on us other than VBS and one or two banks many years ago. We then have government bonds, which might yield a little bit more, unit trusts going to the JSE. But if you're in your own business, that is the riskiest. Okay. You're highly concentrated, you can't trade your shares. And as a rule of thumb, from the private equity models, corporate finance models, and just as a goal, I like entrepreneurs to set is a minimum return on equity of 25%. And I find when you set that goal, it starts aligning people's mindsets. What is return on equity? Well, it's your income over the amount of money you've invested. So in the savings account, you put in 100 Rand, you'll make 6 Rand. A unit trust, you'll put in 100 Rand and you'll earn 15. Chances of losing on a unit trust, a little bit higher than a savings account. A business, it can all go wrong, and that's why you would like a 25% return. This is quite an important concept to learn and stick to, because if you're not making 25% return in your business, well, rather go get a job. Okay. This diagram here is a framework which I've used many times. It's freely available. If you look on the web under Kaplan, Kaplan, framework off the Balanced Scorecard, which comes out of Harvard. I love this. When I was at Deloitte Consulting, we had this lovely big fold out. It was probably about A1 in size with all the different connections of how to improve a business. And it really just comes down to here. So, what is our objective? Our objective is to improve our shareholder value, i.e., create the value for ourselves. And you get that in two ways. You get there by growing your revenue or by being productive on your costs. And this is where we've had an imbalance in accountants over many years. So we like our accountants in the past have been all about cost control, and they've all been about looking after the purse strings and being a steward of the money. But the business guys get very upset because they want the accountants to be more revenue focused, more commercial, more deal making. And that goes out of balance every now and then. And that's when you get the corporate failures, et cetera, et cetera. So I sort of have found a nice niche in sitting between the two. And so right now, what is my thrust? Well, my thrust is on productivity. With tariffs coming in at 30%, my clients at export had just said, no, can't take the risk. It's hard enough to make 20% on export. Now you've got to give 30% away, or your customers have to pay 30% more for tariffs, which means they want 30% off your price. It's just not viable. So most of my clients are exiting the export market, and we're having to look at very carefully, how do we get more out of the same, and how do we recalibrate our overheads? So all very good. That's you've got to grow revenue and you've got to be productive, wise with your spend, but very much aligned to your value proposition and your clients and what your clients are expecting. And then there's a whole lot of good business process which needs to be in place. And those of you familiar with company valuations and apologies and how the stock market works and PE ratios. PE ratios hinge around all of this. They hinge around the quality of your customers, the quality of your controls, outlook for the future, how you look after your costs, but also they look at how sustainable the business is and and productive it is, and does it have good innovation processes? Does it continually have good customer processes, good operational excellence in terms of logistics operations and regulatory and compliance? Now, finance, unfortunately, covers all of these. And I keep saying in a lot of the organizations I work in as an accountant, everything's got a number on it. So everything lands in the finance department, which makes it very hard for an accountant or a finance manager to create the boundaries, etc. So be gentle with your accountants, but make sure you get the numbers out of them. And that transition from going from a small one-man practice to ultimately being, like an ENS or a massive multi-branch organization or a multinational or global firm, the bookkeeper accountant you started with is probably not going to survive the journey to being the CFO of the organization when it gets to that level. And that's a treacherous road. And that's typically where I come in as well. I sort of play a bit of a fractional role where before an organization can take a full-time CFO, I share a little bit of my time with them until we can position the organization for something better. But 9 times out of 10, organizations don't realize that they need that step change in their finance function. And that's when problems happen, because when people start seeing there's a problem, it's actually been there for quite a while already. Anyway, so that's just a framework. It's readily available if you're wanting to understand a business, if you're wanting to understand financials. You need to give it in context with this, particularly when it comes to mediation, disputes with shareholders, particularly when it comes to exiting a business, and you're trying to agree a value. It's beauty's in the eye of the beholder. You've got to be looking forward, but you've also got to be looking at the past to see how realistic the future is and the future expectations are. But I'm not going to go into too much detail on that at the moment, but you'll see why setting the goal and being aligned on the goal becomes quite important. Because if you can't do that, you're not actually going to have anything to measure against to see how you're doing. All right, so the history and importance of the accounting. So accounting started, when the first person got lent money to run a business, and they had to account to the person that lent them the money. And in the days before there was paper and what have you, it was a verbal, and there used to be a third party that used to sit there that was called the auditor, who would hear how the person accounted for what they had done with the money. And over time, the double entry system was worked out. And all that's happened on the double entry system is that we've automated it, and you can't necessarily see the double entry, but it's all automated. And we've gotten very clever at how we can work in the gray area, vis-a-vis, Steinhoff potentially calling certain things cash when they were the furthest thing away from being money in a bank account. All right, so CFAs, not CAs, there's approximately 79 entries or adjustments they do to a set of financials for their analysis, but it can get quite complicated. But it starts with, what is your strategy to achieve what your stakeholders want, turning that into a financial plan, turning that into a budget, and then going off doing your work and recording how you did. So on our simple basis, our plan might be to bill 100,000 this month. How did we do? 50,000? Oh, better do something. Now, what do we need to do to get from 50 to 100? Well, that's your revenue growth plan. It comes back to your value proposition. It might be that you actually forgot to keep a timesheet and you lost 50 hours because you forgot to record. My one colleague I worked with used to spend every 6 months billing. It was actually quite atrocious. I got named in his divorce papers when his wife was trying to actually understand how much he earned. Anyway, so we record the actual results against a budget to see what's different to what we expected, and that comes down to realigning. Yeah. A very important process is the self-learning and the continual improvement, continually trying to understand why you didn't achieve what you expected, or if you achieved something more than you expected, why, and build forward. But very few people do a lot better than they expected. It's normally, not doing as well as I expected. Okay. Very important process, and that is the accounting process itself. And everything I go into now needs to be taken into context with this. So if you have the ability to put a financial plan and a budget together, you have the ability to understand your actual numbers compared to it. Your accountant probably doesn't understand your financial plan, probably doesn't understand the intricacies behind your financial budget. And one of the biggest hassles I have is people put a plan together, but then they haven't really spoken to their accountant. So the way it pops out of their management accounts is quite different to how they've put their budget together, and they just can't work. So the first thing I do is if I come in and see a budget and I see actuals that are different, I just know there's a disconnect. And I know that my role is to facilitate a conversation and to put in this budgeting planning process and make sure the accountants understand it. And that the accountants get told about what's happening in the business so they can expect and adjust systems, controls, processes. Cool. So recording what actually happened. Now, some of the venturers that I work with, it might just be as simple as a book. So I've done hairdressers, literally just how many people did you see today? Just write it all down. So who are we reporting for? Primarily, you should be doing your financial reporting for yourself. No matter what anyone says, you're doing it for yourself. You then have stakeholders. So there's your bankers. And in my case, I report to my wife. My wife sets me a target. And I have to account as to whether I've met it or whether I haven't. But I've got bankers and I have people that need to know where I'm at. And then I have my SARS and SIPC compliance. So yes, there are people that are accountable, but you need to be the one that wants to know your numbers. In what? I've spoken a book, a spreadsheet. There are smaller accounting systems which don't cost you too much, but the reporting might be a problem, right the way up to the big SAP JD Edwards, which take millions of rands to implement, years of your life, and you only hear bad stories. And then how? Okay, again, I go down to the book. Do it yourself. The most important thing to do in a business is an invoice. Make sure all your time, all your sales are actually recorded. Because if you can't record your sales, you're not going to collect them. It's not going to turn into cash. As you grow, you can buy your own accountant, and then over time work out how much you want to outsource or do yourselves. But very important to record what is actually going on. Okay. Particularly at the revenue, then at your costs. With that, you can start working out where you are. All right, so I'm going to delve now a little bit into the accounting report. So this first thing here is the Anglo-American set of financials for December. Now that's the income statement, balance sheet, and cash flow. And these are 3 pages out of a 300-page report. So 3 pages of statutory, some supporting notes that are governed by IFRS, International Financial Reporting Statements. And then there's a whole lot of description around why you should buy the shares here. Okay. So that is up to a listed level. Now, that just looks like a quagmire of numbers. And this is where I find the demystifying starts. And it was very interesting. One of my mentors, when I spoke about doing this presentation for the first time, helped me see this slide. And the question I ask my venturers is, how many numbers do you see? Now, it's a bit difficult to get the answer here, but I'm going to say, well, there's actually only 9 numbers. Okay. And 10 if you count the little 0. So knowing your numbers, there's only 9 of them. Okay. So hopefully that's not demystifying. Hopefully that's not too complex. Okay. I mean, we learned that by, I'd say, grade 1. We sort of had mastered 1 to 10, and we had started to learn to do the sums, our multiplication tables. And some of the best entrepreneurs I know can do these sums in their heads. Okay. Because the foundation is knowing those 10 numbers. The complexity comes in how you group those numbers. Okay. And that's where it does get a little bit more complex, but break it down. There's only 9 numbers. Every time you're feeling a bit overwhelmed, take a deep breath. There's only 9 numbers, and my accountant should be able to tell me every number, and I should be able to understand every single number because there should be a schedule behind it. Okay. So important concepts. We have 3 financial statements, which is what you should be looking at on a monthly basis in your own accounts. Your clients should be looking at them monthly, etc. So profitability, as I mentioned above, is reflected in the income statement. Liquidity in the cash flow statement and to some extent in the balance sheet as well. And solvency is the balance sheet. So you look at the income statement to see how you're tracking in terms of making a profit, because that is one of the goals. Cash flow to see where the money's going, and balance sheet to see how solvent or well structured you are from a balance sheet perspective. And I remember our lecturer at varsity, James Luke, said, it's crazy that we have to report balance sheets and numbers because people don't understand. Imagine if you just put a picture of a face. Is it a smiley face with a big left ear? Yeah. So anyway, he never quite got to actually demonstrate how you could demonstrate it in a face. But I think if somebody could work that out, they're going to be training finance very well. But all right. Income statement. It can be hugely complex. Okay. I have clients that like to have the current month, actual budget, variance, percentage of sales, last year, percentage of last year. Then they like to see the same for year to date. Okay. Then they like to see it on a month by month basis. And there's just so many numbers on a piece of paper, you don't see the wood for the trees. Okay. But at the end of the day, we're trying to understand, are we generating more revenue than expenses and showing a profit? Then we're starting to say, are we making enough profit? Okay. And if you're not making a profit, no matter what happens, nobody's going to like you. In my case, my wife's not going to like me. My banker's not going to like me. I'm not going to like me. Okay. And one of the failings I see as a business rescue practitioner, businesses in trouble tend to think they can, up until that point, think they could have, traded them out of the situation by just trying to get more sales. Unfortunately, sales might happen, costs do happen. And I learned that very valuable lesson sitting in Dubai and trying to sell one of our businesses that was in distress. And very interesting. The Dubai's people just said to us, revenue might happen, costs don't. So all we're going to do is we're going to buy your business, we're going to put some money in, and we're going to cut your costs. And we were able to sit back and say, well, maybe we should just do that ourselves. Okay. So this income statement is something you should be looking at as often as possible. And there's things you can look at on a daily basis to make sure that you are tracked. So revenue, tracking daily. So I track my time every day. How many hours have I charged? How much of it was productive? Monthly, I look at my expenses, and every now and then I look at my profitability. Yeah. But this is where you fix stuff at its simplest level. And you don't need anybody to help you with this. If the numbers are wrong, you're going to make the wrong insights. Okay. As we get into income, we can get into more complexity around knowing your revenue by products and service, by price point, by customer. So for instance, I know that my fractional CFO work, whilst it's more stable and I'm benchmarked against a different thing, my rates tend to be lower than if I'm doing corporate finance advisory work, etc. But Professor Vigario, my Manic lecturer, was very clear. If you don't have enough volume at the right price, you're going to land in liquidation. Okay. You have enough volume at the right price and keep your costs under control, you're going to prosper. Yeah. So in any turnaround I do or any situation, it's what is the first milestone? Well, the first milestone is survive. Okay. Once you get through survive, try and succeed. And once you've succeeded, try and prosper. And it goes through the crawl, walk, run. As babies, we don't pop out and run a marathon. We go through a journey, and it's very similar in a business point of view. So knowing where you are, setting a financial plan that realistically can work you to how you can prosper. And generally in all the restructures, turnarounds I see, don't expect revenue to double in the next 10 months. It won't. You're going to be very lucky. Rather take a lotto ticket, but plan on it going up slightly slower, but take your costs down and build yourself up solidly. And one of the other important lessons I've learned, entrepreneurs see expenses as an investment. No, they're costs. Okay. All right. So turnover, you might have heard this, turnover is vanity. And I see entrepreneurs, and in my experience, I see entrepreneurs that are very sales focused on genuine entrepreneurs. Your good entrepreneurs know that turnover is important. They know you got to grow, but they know that profit is important, more important, and they know that cash flow is even more important. And they know that the controls and structures are actually very critical, and they have this natural inherent ability to put that balance in. So quite a few of the turnarounds that I get involved in are entrepreneurs who just all turnover based, but don't watch the bottom line and certainly don't watch the cash flow. So we see it with salespeople; they do fantastic deals. I've opened up a 200,000 rand account. What they don't realize is that it's a 90-day account with a 5% margin, so it doesn't even cover the interest. Okay. So yeah, turnover is vanity. So we go down to expenses. Now, knowing what your costs are and how they behave is something quite important as well. So unfortunately, when we produce financials, statutory financials, you can't see this. And when you get typical bookkeeper accountants producing financials for VAT and for financials, not management accounting, you don't see this cost behavior. So your typical management accounts will go advertising, accounting fees, bad debts, bank charges, alphabetically. Okay, well, costs don't behave alphabetically. Okay. So from a management accounts perspective, and this is what you need to do for yourselves, management accounts, is understand your costs. For me, fixed costs can be evil. Okay. The more fixed costs you got, the more sales you got to make. Understanding your variable costs and cost of finance. So any turnaround type of work I do, we try and understand what those overheads are, and we try and work out what is the minimum amount of overheads we can run this business, and can we convert more of that to variable? Okay. As you grow as a business, you might very well say, well, I'd actually like more margin for scale. And there's certain fixed overheads or things you buy which you can start internalizing. So as a small business, outsourcing your tax, outsourcing your bookkeeping, outsourcing your payroll, outsourcing your annual returns makes it a variable cost. But in time, as you're growing and you get multiple entities, it may be worthwhile employing your own person and converting that to a fixed cost. But one of the things I do in some of my turnarounds is I take an accounting function which I feel is costing too much, and I just try and outsource as much of the routine bookkeeping accounting as possible, and rather spend our money on management accounting, understanding the costs, understanding the commercials, understanding product costing and profitability. All right. And then the other aspect is your cost of finance. I'm not going to spend too much time in here, but the more debt you got on your balance sheet, the more interest you've got, and the more sales you've got to make. More lower your interest by having just equity and having no debt. Well, you are potentially making that money lazy. Quite a complicated principle, but I'll head on to that when we get into the balance sheet and some of those ratios. So turnover less expenses is profitability, and profitability is the sanity. Okay. So in a lot of the organizations we do turnaround work in, and I've seen it very nicely in some of the factories. I worked in a shoe factory many, many years ago. At 5,000 pairs of shoes a day, they were making a loss. When we restructured it to 1,200 pairs a day, we made a profit. And obviously, and all the turnaround type of work I do is, at some point when you grew the business, you would have been happy with 2 million rand turnover a year. But now you're at 10 million and it's just not going well. I try and say to the guys and the audience, what was it like when you were doing 2 million? You were obviously very happy. There was champagne and caviar. Let's get back to that and rebuild. So profitability. All right, but profit not turned into cash is horrible. Doesn't work. So at the end of the day, it is actually about the cash. So I have recently helped a legal practice to partners dissolve. And the main issue there was the data management. No hassles in writing fees. Plenty of fees being written. Ability to collect it and put it in the bank account, a problem. A real problem. To the point it destroyed relationships. And it's now over. And we hear money is the root of all evil, and it certainly causes problems. So respect it, and you'll be okay. All right, so moving on to the cash flow. And again, I'm going through this very quickly. Cash flow tells us, where's the money come from? Where's it going? It gives you an understanding of how liquid you are. For me, any budget should have more cash at the end than the beginning, unless you've made a massive dividend payment. So in any of my clients' budgets, that's the first thing I look at. What does the cash look like at the end? Yeah. So what does the cash flow? And if you look at any cash flow statement, it says we have cash generated or utilized by operations. Okay, so just to run your business is going to take or generate cash. So if you're making a profit, you manage your stock levels, you collect your debtors, and you pay your creditors responsibly, you should generate cash. If you're making losses, have too much invested in stock, don't collect your debtors and pay your creditors too early, you're not going to have cash. Okay. Likewise, okay, so that's the operation. So in any cash flow statement you will see, and if I pop back up here somewhere, you'll see there's a cash flow statement, and I'm not going to be able to make it bigger, but you will see those headings in any cash flow statement. Okay, so jump ahead here. The next section is investing activities. Now, this is where you've invested in property, plant, and equipment, computers. Now, we all know if you don't continually invest in your underlying assets, you're not going to be able to keep the profits going. So you want to look at a cash flow and see that there is a reinvestment in assets. And typically in a stable business, you want the capex to equate to your sort of depreciation charge. And then we have what's called the funding activities, and that is now you've generated money from operations. You might have put some money into investments. Now, how did you fund either the operations or your investing activity, or how did you return money? So there's a section at the bottom which says we've either raised loans or we've repaid loans. Shareholders have put more money in, or money has been returned to the shareholders. And the sum of A, B, C gives you a movement in your cash for the year. So a good business will generate cash, will reinvest in its business, and will make a return to shareholders of their cash. You do that, you've got Warren Buffett looking after you or looking at your investment. You don't have that, you're going to be battling. All right, so cash flow is the reality. All right, balance sheets. At this point, I want to remind you of what it was like at school if you did accounting and you learned the equation, A equals O plus L. I hated this equation. And I must tell you, my mother-in-law is an accounting teacher of 30 years, and she keeps coming back to this basic. And I'm embarrassed to say that I'm actually now starting to actually understand it truly as it was invented. And that's after 30 years. And it is a scale. And I think we went wrong when computers came in. I think we started restating balance sheets in the vertical rather than in the horizontal like we used to. And I'll show that to you just now. But it is about balancing. So your assets will always equal your equity and your liabilities. Okay, so big equal sign, equal sign, and a balance. And that's why it was called a balance sheet. Okay. So assets equal equity and liabilities. Now, I know from my accounting, your debits and credits, assets and liabilities, assets were at the window and liabilities and equity is at the door. And the teacher made the notes on the board. This is the closest I get to smiley faces and distorted faces, big left ears, small right ears, awkward noses, all gorgeous, handsome people. Okay. So what I've tried to demonstrate on here is what a balance sheet looks like. Now, if we look at a balance sheet now, and to be honest, it's changed about 3 times in my 30 years of being an accountant, maybe a bit more now. And I see there's some older guys in the room who probably still remember the old versions of balance sheets, where they used to be typed out in the horizontal format. But we've gone from showing assets at the top to assets at the bottom to equity in the middle up at the top. So, I mean, you've got to hunt for this now, but we've sort of seemed to have stabilized a bit. But I actually did this. I do this for some of my clients now because they're really struggling. I'm talking clients that are running billion-rand businesses. They still battle with this. And Richard Branson's known for not understanding all of this stuff as well. And forgive me, this is an accountant, so the colors probably aren't great. But with assets, okay, we have three types of assets. Okay, we have what I call are your fixed assets and investments. So these are your tools of your trade and your investments in stock market, in buildings, other businesses. And these things are typically not that easy to convert into cash. Yeah. You can, but if you need to offload them in a hurry, you're probably not going to get the value you need. Okay. So those are what we call your fixed assets and your investments. You get two categories of current assets. Now, on the financials, it's just current assets, and you'll see it disclosed, and there's subgroupings within current assets. But I like to separate out stock from my debtors and bank accounts. And this is an order of liquidity. Yeah. So the principle of liquidity comes into the balance sheet as well. So your fixed assets at the top here and investments are not as liquid as stock. So it takes a while to convert stock into cash because you sell it on credit, most probably. Or if you're doing a cash deal or trying to move it quickly, you're probably selling it at below cost, which is not going to help you with profits. And then we have debtors and cash. Cash is cash, and the hardest bit might be moving it out of a fixed deposit and waiting 30 days and paying a penalty, or it's a debtor that will pay you in 30 days' time. Okay, so those are our assets. Similarly, on our liabilities, we have two categories, and I've structured this for a very important reason. We have our long-term liabilities, which is where you pay stuff over multiple years, but there's a repayment commitment. You typically pay interest for that. Okay, it's provided by an institution or by a shareholder, and you pay interest, and it's typically secured, and those providers of that debt will typically be paid before shareholders in a distressed environment. Equity is what the shareholders, owners of the business, put in to make sure that the business can meet its obligations and operate. And then we have our current liabilities are our creditors, so people that we bought stock from or consumables or supplies. In our cases, as attorneys and accountants, some of our contractors that we might have to pay, our advocates, etc. Okay, so now I've tried to apply colors. Okay, so at the end of the day, assets can only be funded by shareholder money or owner's equity and liabilities. Okay. Equity can start with 100 Rand and then be an accumulation of retained income. So profits you've made over the years, which you haven't distributed, and the balance is debt. Okay. A very unproductive business or very lazy capital is where you don't have any debt. And you'll find that if you've got a big equity with a profit, your return on investment is low. But if you have a low equity with the same profit, you have a higher return on investment, so therefore you're more attractive to a potential investor. But if you get these ratios between debt and equity wrong, you just go over the edge where now you're not attractive anymore. Okay. And the reason for that is your interest burden is huge and starts eroding your profitability and erodes your ability to generate. So those cogs, if I go back to the cogs, which I'll show again just now, you'll see that, as you make less profit, liquidity gets tighter and the closer you move to insolvency. Okay. And sometimes in those situations, we quickly throw in some more shareholders' money, but we're putting good after bad unless we get the profitability right, et cetera, et cetera. I'll also see situations where people make a buying decision which is not appropriate, so they land up with the wrong stock, or they have a customer that goes bankrupt on them, okay? And they try and trade out of it. At some point, maybe you've just got to put the cash in, take the loss, and reconfigure yourself. And that's where business rescue, insolvency, and your creditor compromise legislation comes in. So if you fundamentally got a good business, but you've had some bad luck, that's where the business rescue and the restructuring can assist. Right. So ratios. This is some things. So I've tried to graphically say. So typically what we want in a business is that the debtors in cash should equal your current liabilities at a minimum. And that's on the basis that anything you owe people within 30 days, you're going to have in cash in 30 days. Okay. If you're in a situation where your current liabilities are starting to go out, so your current liabilities is 2 or 3 times what this is, you're going to be getting into some liquidity issues. And that's normally the downhill spiral. So that's something we watch. We like to look at our financials and see, does that equal? Okay. We also then like to look at our current assets, our stock versus our trade debtors. We like our stock not to be more than what our debtors and cash are. So hence, we don't like our current assets to be less than 2 times the current liabilities. Now, different industries will have different ratios, but as a rule of thumb, this is what you can work on. We then also, when we start looking at our assets, we don't like our assets to be fully bonded or fully debt bound. Okay, so that becomes quite an important. So you'll see here that typically your fixed assets investments, yes, if they're good investments like a property, etc., certainly gear them with debt, but you need to have some equity in there just to give you some stuff. So just a high level ratio, and there's a lot of complex ratios which people look at. Don't get too confused. If you're looking at your solvency ratios, i.e., debt to equity mustn't go more than 1 to 1 to 1 to 3. Some businesses can go debt, 3 parts of debt for 1 part equity. That is pushing it. 1 to 1 is very comfortable. 1 equity, no debt, not efficient. Okay. We then, as I've mentioned, we like our current assets, current liabilities to be 1 to 1, and our current assets 2.1. And then most important is our return on equity, is our profit, i.e. our profit over this number here. And when we look at corporate finance people playing with balance sheets and restructuring, and informing dividend policy. So one of the ways you can show better results or better return on equity is if you've got lazy equity, you declare a dividend, you return that money to the shareholders, and let them divest and put that money somewhere else. All right. I thought I should just cover a bit of valuation here as well, and perhaps this warrants a separate webinar all on its own. But people get confused with goodwill and they get confused with asset value, etc. Fundamentally, the purchase price of the business or the value of the business is at a fair market. What would one party pay another party for a business? And it's again, beauty's in the eye of the beholder. So you might think it's a lemon. I might think it's, the best thing since sliced bread and lemonade. And we have to find ourselves. So some of the mechanisms we use for trying to find each other in a price. And I say that's where. So normally if you're within 10% of each other, you can do a deal. If you're way out, it's never going to happen. But some of the mechanisms best sort of practiced for coming up with prices is earnings multiples. It's the simplest. We take our profit after tax at a multiple of 4, and that typically becomes what the business is worth, as long as it is bigger than your net asset value. Otherwise, you're not going to generate the returns. So we sometimes use earnings multiples, sometimes it's profit after tax, sometimes it's an EBITDA. But again, is it 5? Is it 4? Is it 3? There's a whole lot of work that goes into that. But it comes down to how freely tradable the shares are, what are the economic environment, what's the country looking like, what are the economic prospects looking like, competition. There's just so many factors. So it's not a straightforward aspect, but if a person is buying a business for 100 Rand because the business made 20 Rand profit after tax at a multiple of 5, if the underlying assets were 50, you'd have goodwill of 50. Okay. So goodwill is really the difference between what you've paid for a business and what the tangible assets are. And it's typically represented by what the buyer will see as future income that will be generated over their time. But this is perhaps a lot more complicated, and this isn't something you do as part of your normal. And this is where typically you get a bunch of experts in to do it. Valuations, anybody who does a valuation for less than 200,000 Rand is probably going to make a mistake. Yeah. All right, factors affecting valuations, financial performance of the business. Okay, because that's the profit and it's the cash flow which determines. So one of the ways you do a valuation as well is cash flows. You look at the future cash flows, you try and discount that to a current level and try and get a value there. Again, taking many of these factors into account. So the profits you've made this year, are they abnormal because you got like one big insurance payout or you had one big project? What's it going to look like next year? Maybe so I know the sugar industry, all of a sudden people were not eating sugar because it wasn't healthy, and how we expected our sugar industry not to get into distress was quite surprising. Competition might come in. You've got macroeconomic, like governments putting in trade tariffs, and then company and management governance, where people go out of balance, get a bit greedy, or fall asleep at the wheel, and we see both. Okay, so a business with bad management or cowboys, not going to sell so well and not going to attract great value. All right, I'm not going to spend too much time. We have circulated a video, and for time, I'm not going to circulate it here, but it's a very nice little video I've seen, which just talks very quickly and in a very basic way to what an income statement, balance sheet, and cash flow is. It's about 1.5 minutes, and it just hits the mark. All right, so I did say, when it goes wrong, what do we do? All right, so when it goes wrong, okay, and typically it's wrong because you've run out of money. Okay. Or you're showing a profit or a loss and you're not sure. So first things first, are your numbers correct? And I then just go back and say, whoever's produced the numbers, sit with them and ask and ask and ask and ask questions until you know what it is. End of story. Just keep asking questions. Okay. And if a person can't answer, get somebody who can answer the questions. And then you've got to sit and say, well, am I making a profit? If you're making a profit and your numbers are correct, and you still don't have cash, well, then you've got to start looking at your inventory. Have I put too much money into inventory? Have I got too much inventory on the water? So last year I had this problem with a client, just the way the Chinese New Year fell, the way Christmas season went. My client last year in November had to have put all their orders in on China for stuff that they were making now in July. So we had to have 6 months worth of committed stock. And that just threw cash flow out significantly. Sitting in a great place now, but then have your debtors paid? Have you paid someone too quickly? Could be the issue as well. And we do have this, creditors teams pay creditors before they should. Then maybe you started uncapitalized. Okay, so you didn't have enough money in the business to start with. And if you've asked all those questions and you've found the answers and everything looks fine, then go back and ask, are you actually making a profit? Go and check your numbers again. And just again, are the numbers right is what you're going to be looking at. All right, so that for me is the most important. Know your numbers, ask questions. Don't let anybody confuse you that, no, this is complicated. You shouldn't actually understand. Every single number on the income statement, balance sheet, or cash flow can be supported by a schedule. And you can take that schedule and drill down to a document at some point. All right. Again, just being practical and bringing it down from your own practice point of view. As I said, set your budget, and if you're in a partnership, align on your expectations, and then get busy. Most of the problems I see in practices, multi-party practices, is we can't align on our expectations. Okay, so align on those expectations, articulate your expectations in a budget. Then get busy. Monitor your turnover, monitor your cash flow, keep your records, i.e. billing, timesheets, keep these things. You can track turnover daily. Get your management accounts out quickly, interrogate them, troubleshoot them, and work out how you're going to make them better. But align and make sure that you actually all agree that that's what you're going to be doing. Okay. It's a consultative process in itself. And I'll go back to the original definition. Accountant was somebody talking, an auditor was somebody listening, and a shareholder was somebody saying, tell me what you've done with my money and how you're going to continue to make me lots of money. Okay. All right. And I just come back to there's only 9 numbers. And hopefully you through this, you're a little bit more knowledgeable, a little bit better equipped, a little bit more confident, and have some idea where to start looking at numbers. So I will leave it at that, and I know we're very close to 2, in fact, at 2, so I haven't really left time for questions. But yeah, thank you very much for your attendance. I am available for a few more minutes if there are questions.
Jochen, I can't thank you enough. I know more, but I also know how much now I don't know. So I'd like to encourage you, if you've got questions, Jochen's QR code is there and all his details. And yeah, by all means, get hold of him. But if there are any questions, I'm going to go on mute now and turn my video off. I need to go. But if you've got any questions, please put them in the chat or put your mute off, and let's open up for discussion. Thank you so much, Jochen.
Right. I can't see it. Oh, Tulani, hi.
Oh, Tulani's giving you a clap.
Oh, sorry. Thanks. Okay. Right, thank you.
Please, if there are any questions, go ahead. I'll leave it to you, Jochen.
All right. I can't really see anything. So either everyone's overwhelmed and needs another session to be demystified, or will speak to me privately. But yeah, thank you very much for the opportunity.
No, it was excellent. I've got some accounting background, so I can keep up with some of the like PE ratios and so on. Yeah, very helpful. Mostly helpful is keep track of your numbers, because we can work and we work and we work, but we don't actually know if we're making money. And sometimes in a mediation, somebody will come and say, my business is making 10 million Rand a year. One might think, oh, that's brilliant. But what you've pointed out is that doesn't mean anything if you don't know what the profit is. The turnover is vanity, as you say. So someone who says my business is brilliant might not be so brilliant. Yeah. So that's my take on it.
Cool. Yeah, some of the applications for mediation, as I see it, is potential divorce matters, not an area I want to be playing in. But yeah, we have this equilibrium in our financial system. It's called SARS on the one side and banks on the other. And for banks, you want to show great results, strong balance sheet. And for SARS, you typically want to show low profit. So typically, and you even see with banks now, when banks ask you for proof of income, they just want your tax return. So it's, and unfortunately, in a divorce environment, you probably find guys are wanting to show their income is a lot lower and the expenses are a lot lower and what have you. So it's, yeah, trying to interrogate the numbers to see what is actually going on. Yeah, it can get quite complex.
Yeah, but with that income statement, cash flow, and balance sheet, if you know what to look for, 100%. You can pull out. Yeah, you can pull out things. Jochen, sorry, would you mind making your slides available on our website as well? A couple of people have asked about slides.
Absolutely.
Okay. And Dion asked about the webinar. Just to let you know, it will be available on our website. Just give us a chance to put it together. And I need to thank Snare, our administrator, for starting recording, yes. Because she caught it. I forgot to do that. But it will be available in a couple of days' time, as well as the slides. So thank you, Jochen, for making that available.
Pleasure. Good.
Again, if you need your CPD, please contact Snare on admin@kznmediation.com. Jochen, if you can just put your QR code is there. That's great. All right. It's goodbye from me.
Great.
But Jochen, I'll leave you to close when everyone's gone. Thank you so much, everyone, for joining us. Hope it was helpful.
Great.